Stocks are set to scale yet another all-time high, less than 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, Powell in the spotlight. It's day one for the Fed chair as he testifies before lawmakers who are growing impatient for interest rate cuts.
And NATO leaders gather in Washington as a defiant Biden battles infighting about his presidential campaign.
And Citi says it's time to book profits on your AI bets, even though that rally shows little signs of stalling. They say that the gains in some names is, quote, concerning. Let's take a look at where markets are trading right now. About 30 minutes until the opening bell. We have another rally on our hands. The S&P 500 up about 0.2% in the pre-market. Saw its 35th record close this year yesterday. We'll see if today is number 36. It's a similar story if you take a look at big tech. The Nasdaq 100 currently up about 0.3%. A tiny bit of a sell-off in the bond market. Matt, currently yields on the 10-year up about 1 basis point.
Maybe we're seeing record high after record high because financial conditions are so loose. Of course, the Fed wants its policy to be restrictive, and here you see the blue line showing Fed rates holding high, and yet financial conditions continue to loosen. So that's why we hit record high after record high.
And there's some stocks I'm watching as well into the pre-market because speaking of record highs, you have Intel pre-market set to rise for a fifth day, its longest winning streak since January. Remember, this is a stock still down 32% this year, but it does just go to show that the latest rally in chip makers has some traction. Intel up pre-market about 2.9%. Also watching Boeing taking a little bit of a lift here, but roughly flat on the day. Remember, just a day ago, United said another one of its aircraft lost a wheel while taking off from LA. Remember, Boeing also in talks to preserve government contracts in the United States after agreeing to plead guilty to a criminal charge put forth by the Justice Department. We'll give you updates as we get them.
All right, let's hope we don't lose a wheel on day two of our new show. Open Interest debut yesterday, and there's not much less news today. I mean, it's been incredibly busy for a July launch.
Incredibly busy. Of course, we have Jerome Powell taking the spotlight today. We'll count you down to that one. But if you think about day one, I thought it went pretty well. I mean, we had Howard Marks, we had Greg Jensen, and of course, we had Mike Wilson, Sonali.
We have another all-star lineup today. Of course, Lori Calvasin joining us from RBC, Torsten, Slok. There's so much to unpack here between the equity market and the bond market, particularly before 2 hours of Powell testimony.
Yeah, absolutely. Let's get to what Mike Wilson told us yesterday about the chances of a market correction.
I think the chance of a 10% correction is highly likely sometime between now and the election, not just because of the election, but because uncertainty is going to prevail for a lot of different reasons. Earnings reasons, election outcome reasons, some of the things you mentioned earlier around tariffs, potentially immigration, Fed policy still remains uncertain. So, yeah, I think the third quarter typically is that period and it's going to be choppy.
Now, since he said that, I think a lot more people have been worried. Yesterday, I read Julian Emanuel pointing out that the road to his 6,000 target is going to be bumpy. Let's bring in Lori Calvasin right now, head of U.S. equity strategy at RBC Capital Markets. Lori raised her year-end forecast for the S&P 500 to 5,700 and 5,300. Lori, welcome to the show. Thanks so much for joining us on the inaugural week of our program. What do you think about, what seem like worries about these new highs that we're hitting day in and day out?
So look, I'm admittedly in the pothole camp, as I like to call it. I'm getting a little tired of the correction, pullback, nomer. But the reality is that I do think we might go a little bit higher before we hit that pothole, and that's what we tried to reflect with our target increase last week. If you think about some of the reasons to be worried, I agree with a lot of what Mike said. Seasonality, if you look especially the past 5-10 years, we tend to run into trouble August, September, or October. If you look at the election, usually there's some sort of uptick in the VIX in presidential election years. We haven't really seen that yet. And then also, if you think about what's happening economically, we're seeing consumer sentiment take these hits. It really seems, I'm not in the recession camp by any stretch. I want to make that clear. But we are hitting a soft patch, and the Citi Economic Surprise Indicator has really taken a pretty big hit in here. So it feels like the right time for the market to take a breather. That being said, I've noticed a lot of people are starting to call for that as well. And admittedly, I'm in that camp. But sometimes when that happens, it ends up being more like a 5% drawdown than a 10% drawdown.
You know, it's interesting. At the same time, you have sky-high expectations for earnings season, and whether you're Goldman or Evercore, there's a lot of thinking here that perhaps a lot of this is already baked in. So how much risk is there this earnings season?
So I will say on earnings, I actually nudged my number up from 237 to 242, and I think the consensus is around like 246 bottom up. One thing I will tell you as a strategist, I have really learned that we have to give some respect to the bottom-up consensus estimates. Bloomberg Intelligence does a fantastic job of tracking those bottom-up consensus estimates.
Thanks.
And they do. I mean, they've got some invest data on the street on that. And, you know, what we're seeing right now, there hasn't been too much movement in those recently. They are really baked on the idea that margins are going to continue to expand, so we do have to be mindful of that. But what I will tell you is if you go back and you look since 2009, where the estimates are around mid-year, June or July, that is pretty much where they end up at the end of the year. So strategists like me can come in and run their models and fight and say, oh, that's a crazy assumption. The reality is I feel like I've learned to really give these management teams the benefit of the doubt to manage through for a couple quarters. They keep showing us, especially since 2018, especially on the margin side, that they are able to do that.
Let's talk about the management at some of the smaller companies in corporate America, because small caps, it feels like they just can't get off the ground. I've heard a lot of people tell me that, okay, the Fed is going to cut rates, so buy small caps now. You want to get ahead of that. Then you take a look at the Russell 2000, and it has just badly lagged the S&P 500. What's going on with those small names?
So if you look at, we can't really look at this on the Russell 2000. That's a whole tangent we don't want to get into right now. But if you look at the S&P 600 and the downward revisions to this year's earnings estimates that have been in place so for basically the past year, it's pretty much in line with the median drawdown, the median downward revision. The S&P is kind of flat versus last summer, right? So there's a resilience in the bigger cap companies. The smaller cap companies are not able to replicate. They just don't have as many levers to pull in terms of cost management, whether it's addressing labor, input costs. They're just not able to defend their margins as well. So I think that's part of it. I think the other thing that's happening with small caps is we all just need to stop overthinking it. If you look historically, small caps versus large around rate cuts, they don't tend to pre-trade them. They tend to wait until you actually get the cuts in place, and frankly, sometimes even lag the cuts a little bit and then start outperforming. And so if we think the Fed's not going to cut, to September or December is our RBC house view, it's a little too early to do it right now, especially at the same time that economic expectations really aren't moving up anymore.
Right.
We've lost the economic tailwinds, and we've got this Fed headwind that's still in place, and you've got an earnings headwind.
But Lori, aren't markets these fantastic forward-looking vehicles that are supposed to price things in advance? Why would that small cap trade actually maybe lag the rate cut?
So historically, it just hasn't happened that way, and I think it's because the balance sheets, any metric you can pull up, first of all, small caps, their balance sheets are better than they have been in the past, but they're still much worse than large caps, right? So they are bearing the brunt of that impact. But also, let's just think about practically what's happened over the last year. We had a fierce rally in November and December in small caps. Every hedge fund I talked to was trying to go long small caps, pre-trading their Fed cut bets. Then we get into January and we dial down those Fed expectations. So when I hear those same hedge funds trying to make these long small cap arguments, I'm like, you guys already did this once and it didn't work and you got burned. So I think the fact that that community got burned once is going to make them a little bit more reticent to pre-trade it. Now, that being said, I don't want to be underweight in here. Relative valuations are cheap. And if you look at the CFTC positioning, we're down around SVB low. So I think you want to watch that inflection. But there's no reason to be a hero here. People have already gotten their heads lopped off once by trying to do that.
Speaking of heads being lopped off, you have S&P 500 on track to potentially hit a 36th high today, a 36th record. How do you hedge your positioning from here? Is that perhaps the more important trade?
So I'll tell you what I'm looking at right now with S&P is and with all this stuff that's going on election-wise, and I think, look, there's just a lot of fog out there, right, in terms of what it means for the U.S., but I do think we've seen a little bit of momentum for Trump since the debate. I do watch the betting markets. I know that's very controversial, but what I have found is that if you look at the Trump-Biden spread in betting markets, looking at the RCP average, and you look at it against U.S. relative to Europe, what we're finding is that when Trump has the momentum, U.S. is outperforming Europe. And when Biden is bouncing back, that's when we start to see Europe bounce back relative to the U.S. So I feel like there's fog on both sides right now, in terms of looking at Europe, what all the results there mean, what exactly is going on here. But the one thing we know is Trump seems to be coming out of this with a little bit of momentum, and that's resulting in a buy the U.S. trade.
All right, Lori, hang tight for a minute. We want to take a quick look at markets. We're going to get right back to you. We are, in terms of futures, continuing to see gains on the S&P, continuing to see gains on the NASDAQ. And, yesterday we closed out the S&P at 55.72, as Sonali mentioned, a 35th record high. If we finish even a little bit higher today, that'll be a 36th record. Heading into Jerome Powell's testimony, everybody is going to be watching for any hint that the Fed chair is looking to cut rates, and we'll bring it all to you live. This is Bloomberg. Now to high interest, to look at what's making headlines around the world. President Biden has won support from Alexandria Ocasio-Cortez and other Democratic progressives who previously criticized him. The mood seems to be shifting against calls for him to step aside. He allowed his physician to share health details to quell concerns. The doctor says Biden only saw a neurologist for annual physicals and that he's not being treated for Parkinson's disease. Most of Houston remains without power in the wake of Tropical Storm Beryl. Authorities warn that the blackout may last for days. The storm flooded streets, downed trees, darkened traffic lights, and left power lines on the ground. 3 deaths were linked to the Category 1 hurricane so far. And Fed Chair Jerome Powell begins 2 days of congressional testimony today at 10 a.m. It's his last scheduled address to lawmakers before the election. He'll likely have to defend the higher for longer policy stance and the Fed's claim to be a dependent, especially ahead of a possible Trump regime in the White House. Now, for more on what to expect from Powell, let me go over to Katie.
Definitely of high interest, of course, anything that Powell has to say. So let's get to it right now with Mckee. He is Bloomberg Chief Economics and Policy Correspondent. What are we expecting to hear from the Fed chair?
Well, there are probably 3 categories that Jay Powell will be addressing today. One is the state of monetary policy. And he'll talk about how the Fed is committed to its 2% target. They don't have enough confidence to start cutting rates, but they will do so when it is necessary. Basically the same stuff that we have been hearing, because he doesn't want to go out on a limb with CPI coming out on Thursday that could change everybody's perception of what monetary policy should be. There will also probably be a lot on banking regulation. That's what we got at the last Humphrey Hawkins testimonies, both in the House and Senate. Senators and congressmen wanting to know how tough the Fed is going to be on Wall Street. Powell last time said they were planning some major overhauls of the regulations. We'll see if there's been any progress. And finally, as Matt said, the question of Fed independence and the question of what happens politically going forward. Republicans, Democrats will try to get Powell to wrap himself in their flags, and he will probably say, we are independent, we're going to remain independent, and we don't want to get involved in any political discussions.
Mckee, we thank you so very much. We're looking forward to catching up with you later, closer to the Fed's testimony. But meanwhile, strategists at Citigroup out with a note this morning saying that now might be the time to take profits from some of the biggest names in AI. And yesterday's trade suggests that the AI rally actually might be now broadening out, with Corning, Supermicro, and Intel ending as some of the biggest gainers on the day. And we spoke with Greg Jensen of Bridgewater about how they're playing the AI trade.
Big productivity miracles are pretty separate from economic cycles. So when you look at what we're doing at Pure Alpha, we're generally trying to make sure we don't have too much exposure to whether the productivity miracle works out or not. So when we trade U.S. equities, we trade them kind of with AI hedged.
Lori Calvasin of RBC Capital Markets still with us, and curious, Lori, about how you feel about this Citi call, this idea that maybe we're not in a bubble here, but maybe that it's time to take profits in those high flyers.
So I sympathize with the impulse. I'm not sure I'm quite on board with the timing. And in terms of why I sympathize with the impulse, if you look at the top 10 market cap names in the S&P, I think they're trading around like 27, 28 times forward earnings now. We've seen them get as high as 29.8. That's really close to the ceiling of about 30, 31 times that we've seen post-COVID. So they're having trouble breaking through past highs. If you also look at the CFTC data on NASDAQ 100 futures positioning as sort of a proxy for positioning in this trade, it's basically, kind of starting to move back to past highs. It hit them, moved down. It's looking pretty elevated. So I get the impulse. I think the problem is in terms of timing. I think you really have to see the earnings prowess proved of the rest of the market. If you look again, I'll go back to some Bloomberg intelligence data they put out every week, but if you look at the Mag 7 versus the rest of the market, the gap in earnings growth has gone from about 40% in 2023 on actuals. It is shrinking, so the rest of the market is expected to catch up while that Mag 7 cohort decelerates. The gap is sort of stuck around like 2-3% for 2025, and we haven't seen any movement in that. So it feels to me like the seeds are there. It's not getting the proper sort of water, sunlight, nutrition. I think the other thing, frankly, GDP forecasts for next year are stuck around to 1.8%. To really get back into the value cyclical part of the market, to see that broadening out, we need GDP above average, and average is around 2.5%, 2.6%, or we at least need it to move up the way it was late last year, and it's just sort of stuck. So I get it. I think we should be vigilant, but I'm just not quite sure now is the time.
We all know the market is concentrated, but I think it's interesting to see how that bears out in terms of earnings, right? You mentioned the BI data. I was looking at Torsten Slok's notes. He's going to come on later. He points out that the top 10 companies in the S&P 500 make up 35% of the market cap, but only 23% of the earnings. So his interpretation is the market must be super bullish on their earnings. We know that's true. But also the converse, the market is pretty bearish on the 490, right, in terms of earnings.
But it is and it isn't. Like, if you look at the rest of the market, again, going back to that BI data, I think there was like minus 5-ish% earnings growth in 2023. And so it's already expected to rebound into really healthy territory this year and next year. And I think next year it's getting into kind of like the mid to low teens. So there's already a recovery that is baked in. The problem is just the understanding of how powerful that recovery in the rest of the market isn't improving. Right, and this is one thing I've learned on Wall Street over the years. It's not just about levels, it's about momentum, it's about trend, it's about things getting better and continuing to move on that curve, and we're not pushing that curve. And again, I go back to the GDP data. I think the rest of the market is a bit more cyclical, and if we're not sort of seeing those cyclical headwinds strengthen and they're starting to weaken a little bit, I'm sitting here as a strategist wondering, how am I going to get, let's call it 12% earnings growth in the rest of the market expected for next? How is that going to keep getting better? It's not. It's stagnating. I think it's stagnating because our understanding of where the economy is headed is stagnating.
Well, on the topic of concentration, and to bring it back to the Citi note, they did concede that not owning or betting against AI would, quote, be difficult for many on the buy side. So you think about just how top heavy this market is. It feels like you, at a certain level, can't fight it, that you kind of have to just embrace it and go with it.
I think you also just have to wait for it to shift. And I know we want to forecast every single little move in the market, but I do think, one trade that made sense earlier this year was when we saw utility flows suddenly pick up. That last reporting season, the utility companies all said, hey, we're going to get a boost from AI because of the boost to power demand. That wasn't priced in. That was a cheap sector. It made sense for money to suddenly move there and start chasing it. So I think those are some trades we can look for, but just to sit here and say, it's time to short these things, it's time to just go all in on the other side, I think you want to be a little bit more careful than that.
You've underlined the fact that you're not expecting a recession, right? Even though you don't see GDP really coming back to normal. I wonder how much of a concern commercial real estate is, because I keep seeing, vacancy rates remain high. It's not like more people are coming back to the office, even as more people are getting jobs and, the economy is growing some. We're headed towards a wall of maturity as the Fed is holding at 5% and change. I mean, it seems like a recipe for disaster, especially considering the great financial crisis came down because of other real estate concerns. Right?
I think it's, it's something that comes up a lot in our meetings, comes up at conferences as well. It's something we certainly pay attention to, whether we're looking at REITs or banks when we're reading through transcripts. And here are the two things I've been telling people is, number one, there are so many eyes on this problem, whether you're talking about investors, regulators, or the media. We're all watching it. We're all, really trying. I think that gives me some comfort, frankly. This is very different from the housing bubble, right? When there was just denial, denial, denial. I used to go to those crowded home building conferences and just hear, lies coming out of companies' mouths, right? And everybody would sort of, get frustrated, but half the people were in the room were buying what they were selling. That's not what we're in right now. We're all heavily scrutinizing this. The other thing that I feel like we're starting to understand is this is part of the new post-COVID normal. where simply work from home, not being in the office 5 days a week, that is just sort of around to stay in some shape or form. And I think that this sort of commercial real estate headwind, it's a slow-moving train wreck, right? I think that it is being dealt with. It is still a concern. It is still causing some problems, but it's moving slowly enough people are able to manage the fallout.
Well, that's a reassuring note to end it on. Lori, it's always great to see you. Really appreciate your time today. Our thanks, of course, to Lori Calvasin of RBC Capital Markets. Now, coming up, we're going to take a look at the companies making the most social buzz today in our Social Climber segment. Up next, this is Bloomberg. All right, it's time now for Social Climbers. A look at the companies making waves on social media this morning. And first up, big trouble in big oil, with BP saying it expects significantly lower refining margins. The energy giant also predicts a write-down on the value of a German plant of up to $2 billion. That, of course, is the latest in a string of impairment hits and lower profit announcements in that sector. Next up, we have Helen of Troy losing an epic earnings battle. The maker of Hydro Flax, Vicks Vapor Rub, and Dry Bar products, it announced that profit and revenue will actually fell well below expectations. Now, the consumer products company also slashed its full-year outlook thanks to weakness in its beauty and wellness brands. And finally, we have Disney unveiling plans to launch a new cruise ship that will set sail from Tokyo starting in 2028. Disney has plans to launch 3 more ships, including one that will set sail from Singapore later this year. The cruise line expansion comes as the industry is enjoying a rebound from the pandemic, even though, take a look at shares, well, that's Disney. Disney shares just about flat. You can follow all the latest company buzz on TRE & Go on your Bloomberg terminal. But Matt, let's take a quick check on these markets. We are minutes away from the opening bell.
Yeah, absolutely. We're looking at gains again in terms of futures. S&P got an all-time high again yesterday, of course, the 35th record high, and today, if we close any higher, it'll be the 36th. The Russell 2000 futures, so small caps, are down, but not really significant, 0.1%. It's really all about the big tech companies, obviously. That's why you see NASDAQ 100 futures higher.
But it's interesting because you see the Russell still kind of weak here, even when you see U.S. small business optimism really rising for a third month. It's a high for this year. The reason that's interesting is it's because inflation expectations are coming down. Let's see if Jay Powell has the same to say.
But Lori had such an interesting point on the small caps that even though the temptation is to get ahead of the rate cuts, get ahead of that trade, that actually take a look at small caps and that rally really tends to lag.
I wanted to ask about cruises. You guys, does either one of you cruise?
Absolutely not.
No, right?
Keep me away from the
But
ocean.
I have, and I don't either, but I have heard that Disney has like the best ships.
Yeah.
That's what I've, high service.
You do have
high
2
quality
children
service.
now to take them just
Yeah.
there.
It's an
Anyways, coming
opportunity.
up, we're going to talk to Torsten Slok of Apollo. He's going to talk about what he's expecting from Powell today. This is Bloomberg.
All right, moments away from the start of trading on the New York Stock Exchange and the NASDAQ. I'm Matt Miller. This is Bloomberg Open Interest. Take a look at futures. We're up again today. Even after Mike Wilson said on this show yesterday, we could be down about 10%. An all-time record high yesterday. If we finish up today, it'll be an all-time record high for the S&P as well. There you hear the bell ringing at the New York Stock Exchange. Genworth Financial celebrating the 20th anniversary of their listing there. And on the NASDAQ market site, Chicago Innovations ringing the bell. Let's go over to Katie Greifeld right now and see which stocks are moving right at the start of trading. Katie?
Yeah, one stock I'm keeping an eye on at the open is Nike. You have the sneaker giant taking a senior executive out of retirement to help with their slumping sales. Of course, we got a pretty ugly earnings report from them a couple weeks ago. The stock is down 33% year to date. You can see Sonali right now currently up about 0.4%.
Katie, I'm also keeping an eye on Boeing, fluctuating a little bit pre-market here. Remember, yesterday, United said another one of its aircraft lost a wheel while taking off from L.A. Boeing is also in talks to preserve U.S. government contracts after agreeing to plead guilty to a criminal charge put forth by the Department of Justice. Boeing now down about 0.25%.
All right, Intel, also a stock we're watching, gaining for a 5th straight day this morning. There's been a lot of talk, especially after that Citi note, about broadening out your AI investments. And there's some technical or optionality involved in this. Let's get a closer look at Intel with Bloomberg's Abigail Doolittle. Abby?
Well, as you mentioned, Matt, we do have Intel up for a fifth day in a row. Over the last 5 days, up more than 10%. The best 5 days going back to November of last year. So investors liking Intel up 2.8% this morning. You were just mentioning the option action because from a fundamental standpoint, there's not a lot of new news except for the possibility of what you were talking about, a catch-up trade. If we go into the Bloomberg terminal and take a look at what's happening for options, we have an absolute surge here in call buying, suggesting that that some investors think the stock will go higher. What could that be? Well, AI. They, of course, have struggled with some of their more traditional businesses, the foundry. The AI has been off to a slow start. If we take a look at a chart of Intel relative to the SOX and NVIDIA, take a look at NVIDIA up almost 160% on the year. The SOX up about 30%. There is Intel down more than 30%. A beautiful catch-up trade if Intel can put up results. Investors right now betting they can.
Yeah, we'll see, of course, if Intel can actually pull it off. Abigail Doolittle, thank you so much. Meanwhile, markets will also be keeping an eye on Jerome Powell's testimony starting in about 30 minutes' time. And joining us now to help preview, I'm thrilled to say we have Torsten Slok. He is Apollo's chief economist joining us on set. It's great to see you, Torsten.
Thanks for having me.
So let's talk about Jerome Powell, because he's made very clear that he would like to cut rates. The data so far hasn't been quite cooperating with that impulse, but maybe a little bit of weakness in the last couple prints. Where do you think he stands right now?
Well, I think for him today, the reality is that we still have 3 inflation prints before the 18th of September FOMC meeting. So that means that he doesn't need to come out with a strong view in either direction. It's pretty clear that they will not cut in July. And it is quite fascinating how the market always says, oh, it's not this meeting, but the next meeting is when the cut will come. So I still think we have some time here for at least 2 or 3 more inflation prints before we find out if the Fed has enough confidence in inflation actually moving down towards 2%.
Why do you think no cut in July? Peter Cheer of Academy Securities was on earlier, and he said he thinks it'll be in July. It's the last day of July, right? Because the Fed doesn't want to cut too close to the election.
Well, I think there's a number of challenges with that view. Namely, first of all, if you look at the weekly Red Book retail sales data, is still very strong. If you look at auto sales monthly data, also very strong. If you look at some of the numbers that have been coming in across the board on CapEx spending, on AI spending, on AI earnings, and when it comes to the value of stocks going up, the tailwind to the economy from easy financial conditions is also very strong. So I think that for the Fed, the issue is they need to get inflation to come down towards 2%. And we'll see on Thursday what we get on CPI. But the question is whether they will have that confidence at the end of July. And I still think it's questionable. If this is the case, they definitely need to change their communication sooner rather than later.
If I type ECSU on the Bloomberg terminal, I see economic surprises, and they're all to the downside. And I read your notes every day. You've mentioned commercial real estate recently and the fact that vacancy rates continue to remain high. I was talking about this with Lori Calvasin. And there's a maturity wall coming due. You know, isn't the Fed worried about tripping us into a recession?
I think they are, but from their chairs, they will probably say, well, we need to raise interest rates to make it more difficult to get financing for consumers and for firms and in commercial real estate. And if you look at the progress of this process of the Fed having raised rates since March of 2022, we're just still not quite there yet. If you look at the employment report last Friday, for the last 3 months, employment growth has been 200,000. For the last 6 months, 200,000. For the last 12 months, 200,000. Yes, the unemployment rate is going up, but a very important reason why the unemployment rate is going up is not because people are getting fired. It's because more people are showing up at the labor force, most likely immigrants and others, that are basically saying, well, we would like to have a job. That's a good sign of the economy actually doing reasonably well. So I still think that overall, yes, that process of destroying demand as a result of rates going up is playing out in certain parts of the economy, including commercial real estate. But when you look at the aggregate impact with 206,000 jobs created in the month of June, that's still an economy that's doing quite well.
Torsten, even though you have a Fed chair who will meet Congress, who maybe wants rate cuts sooner rather than later, you still have a situation where the monetary seems to be fighting the fiscal. How much concern is there that if they were to cut rates and the government keeps spending as it is, then the problem compounds into 2025?
Well, when interest rates go up, of course, interest expenses for the government will go up. It will take a little bit of time, but it will eventually happen. But when interest rates go up, you also have that people who live on fixed income and people who own fixed income, including people who own public credit, private credit, will get cash flows that are higher than they basically have been in decades. Combining that with the stock market going up every day, with home prices going up, the wealth of a significant part of consumers, the wealth effect is just really still quite strong. So yes, interest rates going up is biting certainly harder on highly levered companies, on highly levered consumers, and also on some parts of commercial real estate, to Matt's point. But I still think that the net effect still tells you that job growth is still strong. And yes, again, the unemployment rate is going up, but the rise in jobless claims has also been more seasonal. So we don't see this as any sign that the economy really is slowing down to the same degree that the narrative at the moment is in markets.
I'd really be curious about your view on the demand for T-bills as issuance has been really flooding the market. When does demand evaporate and why?
Yeah, this is really important because there has been a very deliberate decision, of course, to issue more T-bills over the last several quarters. And ultimately, debt levels are growing so significantly that we will need to see more issuance of coupons, meaning bonds and notes. So the more issuance of T-bills rises, of course, it begins to create the question, who is going to buy all these T-bills that are coming to the market? And that begins to raise some issues and fears about what happened in September 2019, where funding markets started to be impacted because there was a significant amount of supply coming to the market. At the time, there was also a lot of issues where supply was so big that created, in particular in the front end of the curve, issues with supply being high. So yes, the change in the structure of debt outstanding is a very important topic in rates markets at the moment.
But when it comes to T-bills and T-bills demand, you've made the case in your notes that once the Fed starts cutting rates, that some of that demand is going to dry up. And I would just want to meditate a little bit longer on why. Because you take a look at money market funds right now, over $6 trillion in there. Is a 25 basis point cut and then maybe another really going to really meaningfully shrink demand there?
That's a good point. And I think fair enough. It's probably not going to shrink demand dramatically, but given the Fed is so keen on continuously telling us that the next move in rates is lower, that means that there's a lot of people that are then thinking about, okay, maybe I should be buying some duration. But what about the front end? If the next move is lower and we'll get a number of more cuts, then that could begin to have some implications for what will happen to the amount of money in money market funds. And the other thing in that discussion is, remember also, what really is intriguing at the moment is that the amount of money in money market funds is going up. And at the same time, the stock market is going up. So we have a very bullish environment where all assets, both the safest asset, namely T-bills, and also the stock market is going up simply because there's still a lot of money slushing around buying investments, both in risky assets and in safe assets.
I have a viewer writing in with a question. I happen to know that he's a bond trader. He's asking, when does the market price out euphoria over a cut for the realization that cuts always signify something breaking in the market?
Well, a very important part of that discussion is, of course, what we've seen in the last few weeks is that with the election coming up, there's a lot of debate about what would the implications be for tariffs, what would the implications be for restrictions on immigration, what would the implications be for the amount of T-bills, and what might even be the restrictions be on in terms of are we going to get a bigger fiscal deficit or a smaller fiscal deficit. So when it comes to the outlook for rates, it is partly the cyclical discussion, meaning inflation, unemployment, jobless claims, but there's also this whole new theme emerging of, does the fiscal position matter? Does it matter that we have more T-bills outstanding, and what are then the implications for the shape of the curve? And the most likely scenario to that question is that we'll probably have a steeper curve at the end of the day if the Fed does eventually start to cut, and we still have some fiscal challenges that are very difficult to deal with, no matter who wins in November.
All right, Torsten, really appreciate you dropping by for our inaugural week. Torsten Slok there of Apollo. Coming up, the 75th NATO summit is set to kick off in our nation's capital with a lot of uncertainty surrounding it, certainly surrounding the president. We'll have the details for you next. This is Bloomberg. This is Bloomberg Open Interest. Let's get you a quick check at what's going on in terms of stocks right now after hitting a 35th record high on the S&P 500 this year. In yesterday's session, we are up again today. You can see 55.84, the level on the S&P 500. The Nasdaq climbing a little bit more than a third of 1% at 20,514. The tech stocks obviously continue to power this rally, even though Citi said maybe take some profits in the high flyers. The Russell 2000, the small caps, down about 1/3 of 1%.
All right, let's get now to some of our top calls. The analyst action that's in focus this morning. And first up, Piper Sandler upgrading Bank of America to neutral. The analyst predicting an uptick in its net interest income after a trough in the second quarter. Of course, we'll get those results in the coming week or so. Next up, TD Cowen raising its price target on Netflix to $775. The analyst cites optimism over membership trends. Now, this move comes ahead of the streaming giant's second quarter results out next week. And finally, we have KeyBank coming out with positive calls on chip stocks. The analyst also raising NVIDIA's price target to $180 thanks to robust generative AI demand. Definitely have heard that one before.
All right, uncertainty is clouding NATO's summit in Washington. President Biden's health, along with domestic elections in France and Germany, are creating headwinds for the alliance. Joining us now with more is Annmarie Hordern, Bloomberg's chief political correspondent, as well as co-host of Bloomberg Surveillance. So, Annmarie, my big question is how many of these leaders are coming over worried about the President Biden they saw in the debate, worried about the President Biden they saw on the ABC interview, and wondering if they're not talking to a lame duck?
Well, take it a step back, worrying about the President Biden that some of them also interacted with. I think they were part of the G7 summit, because we had reporting prior to the debate that there were concerns about individuals in the room, other leaders in the room, other teams in the room, Sherpas, watching the president about how he was really interactive and on it when it came to discussions about Ukraine, but then would sort of zone out when it was some other issues. So this has been a concern, I would say, even prior to the debate for some of these countries. But not only is it going to be overshadowed by Biden and the domestic issues he's facing at home, but you named France. Emmanuel Macron, he comes with his power diluted. Olaf Scholz had a reckoning at the European parliamentary elections. A lot of this summit is going to be about NATO. You had members of the far-right group in Germany actually decide that they're not going to sit through Zelensky's latest speech recently to the Bundestag. So this is a number of these countries coming here dealing with a tremendous amount of domestic issues that's going to overshadow this entire event.
Overshadowing the event and also these early stages of the election cycle, can you give us an update here on how the Democratic Party is becoming more and more split on the issue of Biden?
There's a schism for sure. I think you have 9 congressional Democrats by either telling Bloomberg off record or finding out from calls that they're saying that they want him to step aside, or publicly coming out and saying it, like we heard from Representative Smith yesterday on CNN, thinking that he says there's another individual that should be able to bring the Democratic message more clearly forward. Do these calls grow? Potentially they do. Senators are going to be behind closed doors today. Potentially you hear more about more people coming out and saying he should step aside. But Biden tried to do everything he could yesterday. Many are saying it was delayed, but he went on MSNBC. He wrote a letter to congressional Democrats. He called donors up. And in the evening, he Zoomed with the Congressional Black Caucus. Will this be enough? Thursday is really seen as this test. The White House, jokingly, with our own reporter Justin Sink, is calling it a big boy press conference. He really can't take just 2 to 4 questions. He needs to really be able to field questions from the press on Thursday to show that he is capable of being the nominee, not just being the nominee, but leading for the next 4 years.
So a lot of focus, of course, on that Thursday press conference, a lot of focus on anything he does at NATO. But of course, this NATO summit, it's happening, 4 months to go until the election. And if Trump gets another presidential term, I mean, what could that mean for the future of NATO?
Well, that's why there's some consternation amongst NATO members. You hear people talking about they're trying to Trump-proof NATO. But if you look at some of the facts, Trump wanted GDP of all these countries to be 2%, which they're either at or getting much closer to. He also fortified some eastern flank countries. But the rhetoric sometimes unnerves them, even if some of the actions didn't unnerve them if they were members of the group. And obviously, this is most important for Zelensky. He had told me last week he's not expecting a formal invitation to be into the alliance, but he wants to see that strong commitment from NATO that they're going to be there for basically security guarantees of his country.
But your point, I mean, it's an important one, right? Before Donald Trump was in the White House, these people weren't paying anything for their defense, for what we were doing. And now, I mean, Germany, for example, the biggest economy in Europe, was paying almost nothing into NATO.
Yes, but partially Germany's massive U-turn, was it so much rhetoric from the former president, or was the fact that there was a war now on their soil? I would say it was probably the latter.
Annmarie, we thank you so much for being here. Day 2 of Bloomberg Open Interest. That is, of course, Annmarie Hordern, host of Bloomberg Surveillance. And coming up next, Pershing Square starts its roadshow for what could be the largest fund of its kind in the country. That and more on our Wall Street beat up next. This is Bloomberg.
Welcome back to Bloomberg Open Interest. Let's take a check on the stock market right now. You can see the S&P 500 building on that momentum, on its gains. Of course, yesterday was the 35th straight record high. Maybe we'll see lucky number 36 today. Big tech powering the way, up about 0.4% on that NASDAQ 100. And the small caps, they are your biggest loser today. The Russell 2000 currently down about 0.2%, I would say, Sonali.
And Katie, it's time now for the Wall Street beat. We're going to get to the most talked about stories in finance. First up, an inside look into how Bobby Jane pulled off one of the biggest hedge fund launches earlier this month, of course, in history. There is a most read story here on the Bloomberg terminal by Bloomberg's Hema Parmar, really detailing how he brought people on board here. And of course, this is pretty unprecedented with the scale he's launching at. Of course, in a multi-strategy hedge fund boom that's been waning a little bit, but of course, bringing in still $1 billion from the Abu Dhabi Investment Authority in a more than $5 billion launch.
Yeah, so most hedge funds, I gather from reading Hema's reporting, start small and then grow. Right. And Jane's idea was, we're going to do it all at once on the same day, launch multiple strategies across, $3 billion that he's raised.
The pitch he's making here is that you have a hedge fund that is avoiding the costs, the complexities, if it took longer to build.
Right. No, I get the logic there that you're avoiding duplication. Hopefully, maybe this is a cheaper way to do it in the long run. Can we talk a little bit about how much he actually raised? Because $5.2 billion, nothing to sneeze at, but it's not $10 billion.
It's not $10 billion, and he had to do fee cuts to really get there. Of course, this massive charm offensive. Fun fact about Bobby Jane, though, you guys will enjoy. He was really a pioneer here in some of the big strategies in arbitrage we know today, in index options, for example, and index rebalancing. Well, actually, back at Credit Suisse.
Ah, I see. And so he had led this charm offensive, from the breakers in Palm Beach?
Hopefully, maybe we'll perch outside there next, guys. But there's another story I want to talk about.
Another sort of fee-cutting story, in a sense, right?
Absolutely. Yeah. And we're going to talk about Pershing Square because it has started its roadshow for the IPO of a U.S. closed-end vehicle. It could be the largest fund of its kind here in the United States. And to Matt's point here, it is something that also provides investors here with a lower-cost alternative, doesn't it, Katie?
Yeah, absolutely. So this U.S. Structure, it would have a 2% management fee. He actually has a closed-end fund that's listed in Europe. That one charges a 1.5% annual management fee, as well as a 16% performance fee, which might go a long way to explaining why it trades at that discount. Because it's a closed-end fund, it's at a 22% discount. It's going to be really fascinating to see how this one actually trades with that lower fee. Maybe it won't see quite the dramatic discount that we see in the European version.
But it's interesting how massive his aspirations are. I mean, I know Bobby Jane wanted to go 10, and he only got basically to 5 and change. But Ackman wants to go 25 billion in a closed-end fund. And you showed me a story this morning that reported about all the U.S. closed-end funds only being worth 250 billion. So he wants to raise one that's a tenth of the entire U.S. business.
Absolutely fascinating. And to Katie's point a little earlier to us, this is more than double the size of the fund that's already listed abroad. Remember, this is all part of a grander plan that Bill Ackman has to eventually take his hedge fund firm public.
It's, of course, $25 billion. That would be enormous. We'll see if he can get there. But $10 billion in the Europe vehicle is pretty impressive. This is something I've talked about at length with Matt Levine, for example. You think about sort of Ackman's name brand in the U.S. and the fact that this will also appeal to retail investors as well. You think about Ackman's social media presence, and I don't know. We'll see if it gets to $25 billion, but he does have more of a brand when it comes to the U.S.
Some details of the filing today. The IPO price expected to be $50 per common share. It will list on the New York Stock Exchange under the symbol PSUS. Citigroup, UBS, Bank of America, Jefferies, all just part of a larger group of underwriters.
Like 20
here.
banks are helping him raise it. I mean, you've got to have a lot of banks for that much
guys.
money.
Yeah. Everybody's involved.
And I know we have time to just mention that his buddy Boaz Weinstein has waged somewhat of a campaign against some closed-end funds that have underperformed.
Not his Europe vehicle, mostly just BlackRock.
Which is also at a discount, as you point out.
Yeah.
All right, really interesting stuff indeed. Let's get to the trading diary right now, what you need to be watching this week. Obviously, today, you're going to want to stick with us here on Bloomberg Television. Watch Fed Chair Powell delivering his semi-annual testimony on Capitol Hill. That kicks off at the top of the hour. Plus, later, we'll hear from Michelle Bowman from the Fed, and she has made some very interesting comments, I think, about immigration and its effect on the labor market. On Thursday, we're going to get CPI. That's after the 2 days of Humphrey Hawkins, because Powell speaks in front of the Senate tomorrow. On Friday, we get a kickoff of earnings season. From the banks, JP Morgan, Wells Fargo, and Citi will all show us what they got in Q2. Coming up in the next hour, Constance Hunter, Macropolicy Perspectives Senior Advisor, joins us as we hear from Fed Chair Jay Powell. She'll help us preview the testimony. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. In just a few moments, of course, we're going to be hearing from Fed Chair Jerome Powell, taking the spotlight on Capitol Hill, set to testify before the Senate Banking Committee. But before we get there, we have some markets to look at. So let's do that now. The S&P 500 currently higher by about 0.3%. More so if you take a look at big tech, the Nasdaq 100 up by about 0.4%. The bond market not doing much right now. Of course, you can see we're unchanged on the 10-year yield. That could change in just a couple minutes. And over the next few hours, of course, we will be hearing from Jerome Powell himself.
Can I just point out,
yes.
I know, like, ever since Pharaoh landed on these American shores of ours, we have stopped showing the Dow Jones Industrial Average. The kids don't like it.
It's just 30 stocks.
Right? But it's down as the S&P and the Nasdaq are up. And
I always out for the Russell.
I always think it's, and the Russell is down as well. I just always think it's different. They're 30 stocks, but they're very big stocks.
You could make the argument it's a look at the sort of the real economy of some old economy stocks in there, but I don't know. I'd rather look at the small caps index.
All right. Well, or the S&P, right, or the Nasdaq. But we've been to 40,000, and we're now back down to 39. So I just think it's interesting. I will get over to Mike Mckee in just a minute. And breaking headlines crossing the terminal right now. Chairman Powell prepares to testify. Bloomberg's Mike Mckee joins us with the top headlines.
Well, basically, it's short and pretty much as expected in terms of his prepared remarks. You've pretty much heard it all before. The economy is solid, as is the labor market. Quote, in the labor market, a broad set of indicators suggest that conditions have returned to about where they stood on the eve of the pandemic. Strong, but not overheated. Nominal wage growth has eased over the past year. Inflation has eased, but remains above their 2% target, Powell says, which they are committed to reaching. The most recent inflation readings have shown some modest further progress, and more good data would strengthen our confidence inflation is moving sustainably toward 2%. We continue to make decisions meeting by meeting. So no guidance in the opening statement on rate cut timing. The usual warning that cutting too soon would be as bad as cutting too late. And he does say that inflation is not the only problem out there, referring to unemployment as well. Nothing on bank regulation. Sorry, Sonali. That should be a topic of a lot of questions. Nothing on taxes, tariffs, or fiscal policy, but one pointed Fed comment on independence. Congress has entrusted the Federal Reserve with the operational independence that is needed to take a longer-term perspective in the pursuit of our dual mandate of maximum employment and stable prices. One presumes, guys, the fiscal and political aspects will come up in the questioning, as well as the bank regulation stuff that he did not refer to in today's opening statement.
Bloomberg's Michael Mckee sticking with us. Thanks for that nod to bank regulation, by the way. I'm sure he will be asked about it a whole lot. And joining the conversation here is Constance Hunter, Macropolicy Perspective Senior Advisor. And you look at the initial move in the bond market, just a drop lower in yields and a pull higher once again. And you have a moment here where still, of course, the data is not quite enough. Constance, what are you looking to hear today?
Well, it's not so much what I'm looking to hear. I think he's going to be very disciplined in his remarks. But in that discipline comes information, right? The fact that he's saying we're looking meeting to meeting means that it leaves the door open to September, which is really important. And the fact that the labor market is balanced right now with this level of restrictive rates suggests that it is unlikely to remain so. Equilibrium is a mythical beast, right? We talk about equilibrium in economics all the time, but it doesn't really ever exist at any point in time. It's always shifting and changing. So with rates as restrictive as they are, we're already starting to see cracks in the labor market, and it's very likely those cracks will continue. At the same time, inflation is making steady progress. We're going to get more data later this week, and we think that the combination of those two things will allow the Fed to cut in September.
And even still, I mean, you take a look at some of these headlines that just came out, and I know I'm cherry picking to a degree here, but let's read a few of them. Powell says that basically easing too soon, too much could harm inflation progress, that inflation has eased, quote, notably, but remains above the 2% goal, and also that restrictive rates are helping to balance demand and supply. And Constance, I'm reading through that. This doesn't sound like a Fed chair that's about to cut rates at the end of this month, for example.
No, not at the end of this month is unlikely unless we get a crazy surprise on Thursday. But even then, they're not going to look at just 1 month's data. With that said, rates are restrictive. Cutting slowly and gradually means rates will remain restrictive. And if we look at where rates were coming into the pandemic with this level of labor market, we had much lower rates, right? So it all argues for the fact that rates don't belong at this level of restrictiveness anymore. And if you look around the world at what central bankers say, right, a lot of them are talking about inflation getting to their target within the next year, yet they've already started cutting rates. So this idea that they would begin to cut prior to inflation reaching the 2% target as it's on its way there is consistent with how central banks operate globally.
Constance, I want to say first off, thank you so much for joining us on the first week of our show, Bloomberg Open Interest. I've learned so much from you throughout the years, so I definitely wanted to have you a part of the mix. In terms of rates being restrictive, at the top of the program, I showed a chart of financial conditions as measured by the Bloomberg. You can type FConGo to see that. And they look very loose, right? We're probably going to make a 36th record high on the S&P 500 today. That would, give me more power to spend as well if I'm a consumer invested, and if I'm getting any kind of interest income on my bond portfolio, that's just getting fatter and fatter as the Fed raises rates. So how restrictive are these rates really?
So the key thing in what you said is if I'm a consumer invested, right? So we have to look at how broad-based are people's allocation to equities. Are they accessible, right? Are they in 401ks or IRAs, or are they in liquid, non-taxable accounts, right? So yes, people are getting more interest, and that's great. If they've moved some money into money markets, they're getting more interest. But we look at a broad swath of Americans who don't have as much access to credit. We see increasing auto delinquencies, really back to levels that we were approaching at the beginning of the global financial crisis. We don't see delinquencies in other areas, but I think that there's some concern. We're going to get bank earnings later this week and into the rest of the month, and we'll see some visibility with regard to how banks are seeing credit conditions of their customers. So while for Wall Street and corporates, large corporates, yes, we have pretty easy financial conditions. If you look at small and medium-sized enterprises and households below the median income, they are not seeing easier financial conditions.
This is Mike Mckee. I'm wondering whether or not there is enough evidence for the Fed to get worried about the economy at this point, as opposed to just looking at inflation or the unemployment rate. A lot of the bears on Wall Street are saying the economy is slowing down because, as you pointed out, Constance, the policy is restrictive right now.
Yeah, that's an excellent question. I think I think we're starting to see some cracks. I think the Fed does not want to be anticipatory, right? They want to see the the expression whites of the eyes. They want to see the whites of the eyes of the recession, perhaps, before they start cutting. On the other hand, if they wait that long, it's going to be too late. Ergo, the SOM rule, which we're getting pretty close with regard to triggering the SOM rule. Now, Claudia herself has said that like so many other indicators that broke during the pandemic, she's not sure that the rule will hold this time, and so there does need to be a bit of humility and caution there. But there are signs outside of the labor market. As I mentioned, the higher delinquencies on credit card loans. We're seeing obviously some cracks in real estate, right? If you look at the concessions that builders are giving for new homes and the rate lock buy downs, you're looking at pretty significant discounts in housing prices. Obviously, we know there's significant cracks within commercial real estate. None of that has led to significant contagion yet, but these are signs that there are cracks within the economy the Fed should pay attention to.
Speaking of, Constance, I don't know everybody at this desk wants to ask you the same question about the yield curve, so I'm just going to do it. Carlisle this morning came out.
I lost you.
Can you hear me, Constance?
Now I can hear you. Sorry.
So Carlisle this morning had said that last week marks 2 years since the most reliable of recession indicators, the Treasury yield curve, flashed red. And it's the market's way of expressing the view that current monetary policy is too tight. What is the yield curve telling you?
Yeah, so, look, that indicator is one of the indicators that looks like it broke during the pandemic, in part because we had so much fiscal stimulus that created a lot of extra liquidity, and people didn't necessarily need that much liquidity from the banking system. But we know from the senior loan officer survey, right, that credit is still tight at banks. Banks are holding extra liquidity on their balance sheets because of the inverted yield curve and losses they've taken in their portfolios. And so it's certainly impacts the economy. And one of the things that we had been thinking at the beginning of the year was that the Fed would be able to have data in hand about inflation that would allow them to cut enough for the yield curve to become positively sloping. And to me, this is the big question about where we are. If the Fed cuts because inflation is slowing enough, then they have the chance of being ahead of the curve. If they wait until the unemployment data or other economic data is significantly worse to start cutting, then they risk not being able to uninvert the yield curve, right? If they're ahead of the curve, we could see long rates stay about where they are or inch up a little bit, and the Fed cuts into that, we get a positive sloping yield curve. If the conditions worsen and the Fed cuts into that, we risk not having a positive sloping yield curve.
Constance, can I ask the obvious question, which is the yield curve broken as a recession indicator? Because you think about when we first inverted, it was quite a long time ago.
Yeah, it seems like it's certainly injured. Maybe it's not fully broken, maybe sprained. It is not proving as reliable. But again, that doesn't mean it won't prove reliable in the future. We just have so many reverberations from the pandemic still impacting the data and impacting reliable indicators or once reliable indicators like the yield curve.
In terms of the Fed's independence, Mike mentioned the statements from Powell, and a lot of people now have betting odds higher that Trump wins the White House. How does Jerome Powell react to something like that, or does he at all, Constance?
Well, he was asked about this last week at Sintra, and Powell really excels at navigating these types of choppy waters. He's very steadfast, of course, to Fed independence. And he will just keep hammering that home. And I think it was very telling that in his remarks today, he said it really matters on what happens on Capitol Hill. And that's where the mandate comes from. And that's where I think he is betting that the mandate will remain.
Well, he's betting that the mandate will remain. But if he doesn't remain, how does the market react to that?
Yeah, well, if Trump were to remove the Fed chair and put in someone who was seen as perhaps more malleable, I think the market would send an immediate message, right? The bond vigilantes are always at the corners waiting to take control, right? And as Bill Gross said, I want to come back as the bond market in my next life, right? So you don't go up against the bond market and win.
So, Constance, more on political issues here, because if you have a situation where the market is expecting, say, a cut, let's say September, then what do you have in terms of next year's issues? Because if you look past November and if you had a change in administration and then you do have a set of tariffs that are put on a range of goods, then do you worry about that inflationary pressure once again? How does the Fed navigate that?
Yeah, I mean, I feel like I'm having deja vu all over again, or as my friend Diane Swank says, it's Groundhog Day. I remember in 2016 being asked to write a paper on the border adjustment tax and delving deep into tax policy and the implications. And of course, at the end, they realized that that was untenable because it wouldn't achieve their goals because the currency markets would have adjusted. And so that tax regime was never put in place. I think it's a bit premature to start gaming out what will happen once if the leadership changes, if Trump is elected. There are so many things that can change between now and a time that he's in office and has a cabinet in place that I think it's sort of, I mean, gaming this out is important, but spending too much time on things that may not even come to pass also is maybe not the best use of time.
Well, Constance, when it comes to sort of the political risk, when it comes to Fed policy, of course, as Matt mentioned earlier, we had Peter Cheer saying on Bloomberg Air that he expects the Fed to cut in July, basically to get ahead of the election, so close to the election. But would a 25 basis point cut in September really sway the election at all? What is the actual impact there when it comes to Fed policy, maybe a cut a month before or to the election?
Yeah, I think it's unlikely if they started cutting in September that it would sway the election. Also, this is such a difficult thing to game out, right? We're not in the heads of the FOMC members. We're not in Powell's head, but certainly he said that political considerations don't come up at all. And if you go back and you look at the minutes, you see it's not discussed. They really are focused on what is the economic situation and what are the financial conditions that are needed given the current economic situation.
Constance, do you expect Powell to make any comments on fiscal spending, because it's working at cross purposes with his monetary policy, right? I mean, as he raises rates, we get the CHIPS Act spending billions, the Infrastructure Act spending billions, trillions, the Inflation Reduction Act, which ironically maybe boosts inflation. So, and this spending isn't expected to change regardless of who comes into the White House, right? Drunken sailor, the term drunken sailor has been thrown around a lot in regards to the federal government spending. Is he going to say anything about that to Congress, or does he keep mum?
Well, I think he won't say much. He will try to avoid saying as much as he can. And as I said, he's very adept at towing the line there. However, I don't know that all of this spending is inflationary. It is part of the reason that we've had such a hot labor market and almost a reverse hysteresis that is allowing us to have a productivity surge. And it seems like that productivity surge is going to continue. And so a productivity surge actually makes the Fed's job much easier. So if we go back to the period from 1995 to 1998, when we had a similar productivity surge, the Fed was able to keep rates steady while the economy grew faster and inflation continued to fall. So in so much as much of this spending is targeted in ways that promote productivity enhancement, I think that it's not clear it makes the Fed's job more difficult.
Hey, I want to bring in Mckee for a minute here again, too, because the reality, too, is we have CPI data around the corner as well. And when you take Powell's statements today compounded by that next data point, as he's looking for more data, what are you looking at?
Well, I think you're looking at a cautious Fed chair who doesn't want to get out over his skis, walk to the end of the plank, and might fall off if something comes in weird for CPI. So there's not a lot of incentive for Powell to be very specific today, which kind of tells you something in the sense that if the Fed is thinking about moving at the next meeting, whenever the next meeting is, they're going to want to start hinting at that. They're going to want to price the markets for it so that the markets aren't surprised. So if we get through today and he doesn't say anything about we're thinking about this right now, then you can pretty much write off July, which most of the market's done to this point. And then the focus will turn to what does he say next week when he speaks? Does that set up September? Or what do they say when they get into August or Jackson Hole?
All right, let's take a quick check on these markets. Of course, we are waiting for Fed Chair Jerome Powell to come out. In the meantime, you take a look at the S&P 500. It's really building on those gains. Again, hanging out about 0.2% higher. This slow march to record high after record high today could be 36 record closes in 2024. Of course, we'll have to stay tuned for that one. Take a look at the NASDAQ 100. Big tech leading the way here, currently up about 0.5% or so. And then you take a look at the bond market. The 10-year Treasury yield is what we're looking at. We're camped out, rated about 430, I would say, currently higher by about 2 basis points. And Constance, I want to ask you, where on the curve should we be looking when we're trying to get a sense of where the markets are pricing in the Fed? Because classically, you would take a look at the 2-year yield. But we actually had Torsten Slok argue in a note this morning that it's the 10-year that has been moving around with Fed expectations.
Yeah, he's correct about that. The 10-year's been moving around quite a bit. But I wouldn't exclusively look at the 10-year. I would still look at sort of that belly of the curve, the 2 to 5 year, to see what's happening. And so you're going to need to look at both of those ends of the curve. The 10-year is also moving around in part because of political risk that we see not just in the U.S. but around the world, right? So the 10-year has some noise in it, so you want to look at that plus, I think, the 2-year.
I want to just point out we're still looking at Congressman talking, making statements ahead of Powell's testimony. Sherrod Brown was telling Powell that he doesn't work for the big banks, he works for the American people. And now it looks like Powell is going to start to respond. Let's listen in.
Semi-annual monetary policy report. The Federal Reserve remains squarely focused on our dual mandate to promote maximum employment and stable prices for the benefit of the American people. Over the past 2 years, the economy has made considerable progress toward the Fed's 2% inflation goal, and labor market conditions have cooled while remaining strong. Reflecting these developments, the risks to achieving our employment and inflation goals are coming into better balance. I will review the current economic situation before turning to monetary policy. Recent indicators suggest that the U.S. economy continues to expand at a solid pace. Gross domestic product growth appears to have moderated in the first half of this year, following impressive strength in the second half of last year. Private domestic demand remains robust, however, with slower but still solid increases in consumer spending. We have also seen moderate growth in capital spending and a pickup in residential investment so far this year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, a broad set of indicators suggests that conditions have returned to about where they stood on the eve of the pandemic, strong but not overheated. The unemployment rate has moved higher, but was still at a low level of 4.1% in June. Payroll gains averaged 222,000 per month in the first half of the year. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in labor force participation among individuals aged 25 to 54, so-called workers in their prime working years, and a strong pace of immigration. As a result, the jobs-to-workers gap is well down from its peak and now stands just a bit above its 2019 pre-pandemic level. Nominal wage growth has eased over the past year. The strong labor market has helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased notably over the past couple of years, but remains above the Federal Open Market Committee's longer-run goal of 2%. Total personal consumption expenditures prices rose 2.6% over the 12 months ending in May. Core PCE prices, which exclude the volatile food and energy categories, also increased 2.6%. After a lack of progress toward our 2% inflation objective in the early part of this year, the most recent monthly readings have shown modest further progress. Longer-term inflation expectations appear to remain well anchored. as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee has maintained the target range for the federal funds rate at 5.25% to 5.5% since last July, after having tightened the stance of monetary policy significantly over the previous year and a half. We've also continued to reduce our securities holdings. At our May meeting, we decided to slow the pace of balance sheet runoff starting in June, consistent with the plans released previously. A restrictive monetary policy stance is helping to bring demand and supply conditions into better balance and to put downward pressure on inflation. The committee has stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. Incoming data for the first quarter of this year did not support such greater confidence. The most recent inflation readings, however, have shown some modest further progress, and more good data would strengthen our confidence that inflation is moving sustainably toward 2%. We continue to make decisions meeting by meeting. We know that reducing policy restraint too soon or too much could stall or even reverse the progress that we've seen on inflation. At the same time, in light of the progress we've made both in lowering inflation and in cooling the labor market over the past 2 years, elevated inflation is not the only risk we face. Reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering adjustments to the target range for the federal funds rate, the committee will continue its practice of carefully assessing incoming data and their implications for the evolving outlook, the balance of risks, and the appropriate path of monetary policy. Congress has entrusted the Federal Reserve with operational independence that is needed to take a longer-term perspective in the pursuit of our dual mandate of maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on those goals matters to all Americans. I'll conclude by emphasizing that we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. Thank you. I look forward to your questions.
Thank you, Mr. Chair. And the senior member of the committee will begin the questioning. Senator Reid.
Thank you very much, Mr. Chairman. Former President Trump has indicated that he would propose, if elected, a substantial increase in tariffs of between 10 and 60%, and by doing thus, eliminate the federal income tax. First, on the question of what would be the impact of tariff increases on prices, consumers, and the economy?
Thank you, Senator Reid. So I'm going to say that we go very far out of our way not to comment on campaign type information. We just don't do that. We also don't comment on trade policy. We have really specific and important jobs, and we try to stick to those.
Well, I'm glad I allowed you to establish that principle up front, Mr. Chairman. But let me opine a bit. 10% increases in tariffs is going to have an effect on prices in the shop aisle. It's going to increase them because they'll be passed on likely. 60% tariff increases are significant. And in fact, I've been told that to replace the income tax, you would have to raise tariffs across the board 70% to make up for the loss of the income tax, which would, I think, create huge economic problems. I respect your impartiality and your neutrality, but the numbers don't seem to add up to anything that would help the country. Let me switch to something else that might be more within your line of response. You said in your opening statement that the labor markets appear to be in a better balance. And that's one of the key factors to judge whether interest rates can be raised. I must say I'm concerned a bit that we're not on a very faster track to decreasing interest rates from the Fed, and because of the better balance you cite. Could you comment on that, Mr. Chairman?
Sure. So the most recent labor market data do send, to your point, a pretty clear signal that labor market conditions have cooled considerably compared to where they were 2 years ago. This is no longer an overheated economy. This is an economy, as I mentioned in my opening remarks, that is more or less back by most measures to where it was before the pandemic. And that was a strong labor market, but it was not an overheated labor market. So I think the upshot of that really is that we're well aware that we now face two-sided risks and have for some time. But now, the labor market appears to be fully back in balance. We know that if we move too quickly, we risk unnecessarily hampering economic activity and possibly interfering with the ongoing expansion. We know that if we move too slowly, that we may undo the good we've done. Well, actually, it's the other way. If we loosen policy too late or too little, we could hurt economic activity. If we loosen policy too much or too soon, then we could undermine the progress on inflation. So we're very much balancing those two risks, and that's really the essence of what we're thinking about these days.
But the direction seems to be going towards lowering interest rates at some point, we would hope. That might be a wish rather than a direction.
I think if you look at the last summary of economic projections, I guess I would say it this way. It doesn't seem likely that the next policy move would be a rate increase. We don't take things like that off the table, but that does not seem the likely direction. The likely direction does seem to be as we make more progress in inflation and as the labor market remains strong, we begin to loosen policy at the right moment.
Thank you. Just 2 weeks ago, the Supreme Court handed down 2 decisions that impact every federal regulatory agency, including the Federal Reserve. They overturned the Chevron case, which had eliminated judicial deference to agency decision-making for many, many decades. And they also dramatically extended the statute of limitations under the Administrative Procedure Act. What is your judgment is the cumulative effect of these decisions on the Federal Reserve? More broadly, what does it mean to the economy if virtually any regulatory decision the Fed makes can be second-guessed by a judge? What position are we in now?
So we're as an institution very focused on reading the actual letter and intent of the law and following it carefully. This is a strong institutional value that we have. Those are brand new decisions that just came down, and we're really in the process of just studying some. I don't have anything for you on them, but we will, of course, follow the law as the Supreme Court as the Supreme Court has read it, because that's their job.
Well, thank you, and I concur with compliance with the law. But when you do your analysis, and if it is detrimental to your ability to regulate the banking industry in the United States, I think you have an obligation to make that public. Thank you, Mr. Chairman.
Thank you, Senator Reid. Senator Scott from South Carolina is recognized.
Thank you, Mr. Chairman. Chair Powell, we've heard a steady stream of commentary that there will be changes to Basel III endgame proposal. That can be seen certainly as good news. Some reports say it could be finalized as soon as August. Others say you are circulating a term sheet for a revised proposal. Through it all, this proposal will have outsized impacts on our banking system, from big to regional to our U.S.-based foreign institutions, as well as impeding access to credit for consumers. So even though you yourself have said there will be broad and material changes, I believe this proposal is flawed, both in process and in substance, and should be withdrawn. Do you agree, and will you commit to withdrawing the existing proposal and issuing a new proposal with a robust notice and comment process?
Well, let me update everyone on the status of all that. So over the past several months, we've had, in fact, Vice Chair for Supervision Barr has held a series of discussions with the other bank regulatory agencies around potential changes to the original proposal. I'm pleased to say that we've made quite a bit of progress on those and are very close to agreeing on the substance of those changes. And I can't really be specific because nothing is agreed until everything's agreed, so I won't have a lot of specifics for you today. The question where we're continuing to try to make progress is that of process. So it is my view, it is the strongly held view of members of the board that we do need to put a revised proposal out for comment for some period. And the reason is, when there are broad and material changes, that has been our practice. We don't see a reason to deviate from that practice. It seems to be consistent with past practice and with the Administrative Procedure Act. So that's very much what we think. And we're working through that question with the FDIC and the OCC. We haven't reached agreement on that, but I'm very hopeful that we will. We're prepared to move forward when we do reach agreement on that.
Well, I appreciate most of your response there. I do want to discuss one aspect more of Basel before we move on to another topic. I find it very concerning with how much of this proposal, this process appears to have been done behind closed doors. The Fed, the FDIC, OCC proposed Basel III endgame last July. Then in October, the Fed began the collection of data to conduct a quantitative impact study on the cost of Basel III proposal, a study which I will note should have been conducted before any proposal was ever issued. Move forward to January of this year, Vice Chair Barr committed to a public comment period once results of the study were published. We are still waiting to view the results. Keep in mind, all the while, we're hearing rumors that the Fed is working on revising its proposal and moving towards an updated version. Please help me understand, how will the Fed revise or reissue a capital proposal before receiving public comments? Basically my question.
Well, as you know, we have received extensive public comments, and we've also evaluated the quantitative impact survey that you mentioned.
Yes.
And so the idea would be when we do reach agreement with the other agencies fully, that we would publish the proposed changes and also the quantitative impact survey, and also the effects that the QIS suggests that the changes would have. So we'll put all that out for comment again for a period of time, and then having had yet another round of comment, and we can then move toward finalizing. That's basically the broad strokes of how I would see this moving forward.
And how long do you see that opportunity for public comments?
So it would be meaningful. I mean, it might be 60 days. We don't need to it doesn't need to be a long one. But, before we do that, there's a lot of work that needs to take place, before you actually put out the revised proposal. Quite a bit of work. So it will take some time, and then we would put it out, and then there would be, I'm just taking that number, 60 days of comment, and then we would get the comments back, and there would be another period of evaluating the comments. And only then would you go final. So there are a number of steps here.
Yeah, thank you. Well, just final point as I'm running out of time here. I think Senator Reid made the comment about the Chevron case and the impact that it could have, certainly in curtailing, from my perspective, the regulatory state. The necessity of a cost-benefit analysis on new regulations that will impact the economy, I think, is quite helpful. In the 1,000+ pages of Basel III, I think there were about 20 pages that reflected some kind of cost-benefit analysis approach. I really hope that we see more of that going forward.
Thank you.
Senator Tester from Montana is recognized.
Well, thank you, Mr. Chairman. Thank you for the courtesy. Chairman Powell, good to see you here today. Appreciate your work. Look, regardless of where I go in the state of Montana, housing is a big issue, whether it's Billings or Butte or Bozeman or Busby or Big Sandy, it doesn't matter. Larger towns to medium-sized towns to small towns, housing is a huge issue. And I think it's a huge issue all over the country, and correct me if I'm not correct in that. And I was wondering how the housing challenges fit into the overall economic picture that you're seeing.
So we do pay a lot of attention, and I would agree with you. We have significant housing issues in the country, and we had them before the pandemic. Certainly, the pandemic has created new distortions, and monetary policy works through interest-sensitive spending. There is no more interest-sensitive spending than buying a house and having a mortgage. So, for sure, our tighter policy is having an effect on economic activity in the housing sector. But I would also say the best thing we can do for housing is to succeed in getting inflation down to 2% on a sustainable basis so that rates can come down, so that the housing market can get back to what was the pre-pandemic normal, which is to say still a housing shortage, but not dealing with the kinds of specific things we're dealing with now.
So let me drill down a little bit. I'm speaking not necessarily from a housing cost interest, and you're correct on the things you just brought up. I'm speaking more from a standpoint of economic growth, in that there are plenty of small businesses, schools, hospitals, Main Street businesses that can't hire people, they can't expand because there simply is no place for them to live. How does that fit into your economic outlook metrics? Because I think it's, from my perspective at least, I think it's limiting the opportunity for expansion. It's limiting the opportunity for entrepreneurs, business startups. And does that fit into the economic picture that you look at?
So our mandate is for stable prices and maximum employment. And again, I think for housing supply, the best thing we can do is get inflation under control so that rates can come back down, so that we can have a more normalized set of rates and a more normalized housing system. But I think policies to increase housing supply are really not so much in the hands of the Fed, they're in the hands of legislatures, state and federal.
Do you believe that if we were to put forth some housing incentives, whatever they may be, that could have if those incentives resulted in more affordable workforce housing on the market, that would have positive impacts on the economy?
These are questions for you, but I would say this, that I'm aware that housing is in short supply, and that for many it's a critical need for the workforce.
Okay.
And so more of it is better. But as to where the fiscal policy how you should prioritize that, that's not up to us.
Look, I want to talk about the independence of the Fed for a second, because I know that you are a strong supporter of independence, as am I, and political influence, I don't think, helps with monetary policy in the country. And so give me your perspective, at least, on why the central bank independence is so critically important.
Thank you. I'd be glad to. So essentially all advanced economies have adopted a policy of central bank and operational independence. And that just means that we make our decisions, we're instructed to make them without taking in extraneous factors, one of which would be politics. And the record is pretty clear that that's a good it's a good institutional arrangement that serves the public well. And we just want to stress, as we do periodically, that this is an institutional choice that we make as a country, and that as long as it's seen to serve the public well, it's a good choice. We think so.
Okay, on advanced economies, there's some that talk about the economy of this country not being in very good shape. From your perspective, tell me how the economy of this country is doing compared to other advanced economies that have central banks.
So I'm in lots and lots of international discussions as part of my job, and the story for the last 2 years has been just how exceptional the performance of the U.S. economy has been, and that's not a secret. Clearly the U.S. economy has performed very well compared to sort of our advanced economy colleagues.
Is there any country in the world with a central bank, any advanced economy that's performing better?
Better as a central bank?
Any economy that's an advanced economy that has a central bank that performs better than us?
None comes to mind. As I think of the majors, the answer would be no.
Okay, thank you.
Thanks, Senator Tester. Senator Rounds of South Dakota is recognized.
Thank you, Mr. Chairman. Mr. Chairman, first of all, thanks for coming in again and visiting with us. I just want to focus on two specific items, and I'm going to start with the Basel III endgame discussion. I think Senator Scott did an excellent job of kind of laying out the concerns that many of us have had with it. I would like to go back into just one particular issue, which I think a lot of folks out there that follow this, and I know it's technical in nature, but let me just ask a specific question, and you can kind of pick it apart for me, please. Both you and Vice Chair Barr have confirmed that there will be material changes to every risk type outlined in the proposal. Since there will be significant changes, do you believe where the agencies have landed now would be considered a logical outgrowth of the original proposal from last summer?
For those people who are not familiar with, that's the legal test for that turns out to be if it's a logical outgrowth. If it's not a logical outgrowth, that would legally require reproposal. And I don't want to make the legal judgment. I will just say again, from my standpoint, my view and strongly held view of some of my colleagues on the board is that it will be appropriate for us to put out the changes again for a period of comment, just because it's the right thing to do. It's what we would do typically in a situation where there are, material changes to a proposed rule.
Do you feel that you have a consensus in the board to allow that to move forward in terms of an additional comment period?
Yes, but of course we have to get the FDIC and the OCC. We're in discussions with them to work on something that would meet that need, and we have to get their agreement too.
Assuming it sounds like that's the path that you would like to go down.
Yes.
If that were the case, would it be fair to say that we'd probably be looking at final determinations or recommendations for a Basel III endgame proposal probably into next year before it would become anything of a final determination?
I think that may be right. It's that's something like that could be right. Yeah. I mean, it's hard to be precise. We would put it out. It takes some time to write this stuff up. Then you put it out for comment. Then you get the comments. Then you read the comments. Then you write the final rule. Beginning part of next year is a good guesstimate.
The only reason why I push is because there are so many folks directly involved with this and the impact on our economy here and with a lot of our financial institutions. This is a significant change, and it's one that a lot of people are following. So I'm trying to get you to get into the depth of this as much as possible, and I thank you for that. I'd also want to go into one other area, and once again, this is something that you and I have had visits about in front of this group before, but I want to talk about what the parts of inflation are and what parts you can control and what parts, as the Fed, you really can't control. The demand side of the equation on inflation is the part that you have the tools to work with. But there is the supply side of the equation, which is still out there. And I want to just lay this out because as we do this in this setting, it naturally becomes political in nature because one of the starting points that we talk about is when this administration took office and what happens with supply side issues at that time. And as I work my way through this, I just want to share the concern that I've got. And then I recognize you don't want to be political in it, but I want to lay this out. And then I want to talk about what you can control and what you can't control with regard to making changes on inflation through the processes that you have. When President Biden took office, gasoline prices, since President Biden took office, gasoline prices have risen over 54%. Energy prices have risen 41%. Fuel oil prices have risen 37%. Now, I can go on, but you understand what I'm saying is that energy has increased substantially. And I think one of the reasons for this has been additional demand as we've come out of a pandemic. But the other part of this has been whether or not investors really want to go back in and invest in traditional energy resources after the president made the specific determination to cancel the Keystone XL pipeline on the day that he stepped into office. When he did that, he sent one heck of a message to investors about traditional energy and investing in traditional energy in the United States, and the fact that a multi-billion-dollar contract or contract could be canceled with the stroke of a pen. Now, my question to you is, what percent, or has there been a discussion about what percent or what amount of the inflation that we've seen, over 20% increase in terms of affordability for a lot of our products, how much of that is attributable to the demand side and how much of it really is attributable to supply side challenges that we've seen in this country?
That's a question that we've thought about a lot, and any attempt to reduce that to a precise number would be inappropriate because it's so uncertain. But I think we can say, I believe strongly, there's a significant demand element and there's a significant supply element, and we've seen the supply side heal so much over the course of the last year or so, and we clearly see that that's contributing to lower inflation. We also see cooling demand, for example, in the labor market. So the two forces are working together. I can't really break it down. It would be such an imprecise estimate.
Just simply an acknowledgement, though, that it is both demand.
It's both. It's definitely
and
both.
It is supply.
It is both. Yeah, for sure.
Thank you, Mr. Chairman. My time has expired.
Chair Powell, unemployment has risen by half percentage point over the past year. The number of job openings has dropped almost 50%. The hiring and quit rates are now below pre-pandemic levels. I'm concerned that if the Fed waits too long to lower rates, the Fed could undo the progress we've made on creating good paying jobs. Full employment is part of the mandate, as you say over and over. How are you assessing the risks of higher interest rates in the labor market?
So I completely agree with your characterization. The latest data do show that we've had considerable cooling in the labor market, and we're very much aware that we have two-sided risks now, as I mentioned earlier, and we're determined to balance those as best we can. We want to see more good inflation data, and we also want to continue to see a strong labor market. And those two things are equal under the law. We have this challenging thing to balance them, but we're very much conscious that that is our job, and we're trying to do that.
Well, and you know that if unemployment trends upward, you must act immediately to protect Americans' jobs. Workers have too much to lose if the Fed overshoots inflation target and causes a completely unnecessary recession. We will say that over and over and over again. I think you understand that. Housing, higher interest rates are making housing more unaffordable. Higher rates are supposed to lower cost, yet housing prices continue to soar. By keeping rates high, the Fed ignores the economic reality of the millions of Americans struggling to make ends meet and get ahead. Let me ask you three quick yes or no questions, if you would answer that way. Since late 2022, when the Fed began raising rates, has the volume of housing sales decreased?
I believe it has, yes.
Since late 2022, has the median home price increased?
I believe it has.
Since late 2022, have monthly mortgage payments become more affordable or less affordable for home buyers?
Less affordable.
Okay, thank you. In short, despite housing sales declining, the median price for a single-family home has increased by nearly $20,000. People are spending a greater share of their income in mortgage payments. So in some higher rates, it's clear from your answers and data, it's clear higher rates are not bringing down housing costs. The cost of home ownership is only going up. Let me shift to the Synapse bankruptcy. Since mid-May, tens of thousands of people, including many Ohioans, have lost access to their money due to the bankruptcy of this fintech middleman. Reports indicate that as much as $95 million may have gone missing. The Fed oversees one of Synapse's former partner banks, Evolve Bank and Trust. As a regulator, it's your job to make sure that banks protect the people whom they serve. What's the Fed doing to help customers who felt the impact by the Synapse collapse? What are you doing to regain access to their money?
So we do supervise the bank. We don't supervise Synapse, or let alone the fintechs that feed into Synapse. And we're strongly encouraging Evolve to do whatever it can to help make money available to those depositors. We also, as you may know, did an enforcement action against, before this all happened, we did an inspection or looked at Evolve, and we hit them with an enforcement action around these very risk management issues, again, before the current situation developed.
Okay, it's critical that consumers are made whole as soon as possible. We will continue to talk to you about that. We will watch. We will let you know we're watching. The Fed needs to use its supervisory authority to ensure that Evolve is committing the resources necessary to return those funds to the account holders. Last comment, I want to note one last thing. Last year's Fed report on the failure of Silicon Valley Bank noted how incentive-based compensation encouraged excessive risk-taking that led to the bank's failure. You either watched or had reports of when those bank CEOs testified in front of this committee. The report, the incentive-based compensation that led to the bank's failure, I mentioned, it said that SVB managers, quote, had a financial incentive to focus on short-term profit over sound risk management. That's what a number of us, Senator Smith, Senator Butler, Senator Warner and I have said over and over, that that short-term profit over sound risk management causes significant problems to our financial system. Compensation practices still pose a threat to our banking system. I urge you to move quickly to join your colleagues in the long overdue rulemaking on executive compensation. I mean, you know, you read the reports at the outrage of of the public about executive compensation continuing to go up and up and up and up. You have a role, a significant role, a legal role to deal with that. Thank you. Senator Tillis is recognized.
Thank you, Mr. Chairman. Thank you for being here. I want to be real quick on Basel III Endgame, and I want to be mindful of time. Just simply, can I get a commitment from you on releasing the results of the QIS?
Yeah, we plan to release the results of the QIS.
What time
not just, well, first we have to get agreement with the other banking agencies, but as soon as possible.
Can you imagine any agencies having a concern with, any other banking agencies having a concern with releasing it? Or is it just a matter of pro forma? Okay.
No, it's just a matter of the bigger picture of getting agreement on the revisions to Basel III and also how to proceed.
That's great, and I really appreciate the feedback that I've received from you. I should have started by thanking you again for your continued accessibility and discussions outside of the committee. They're very productive, and I appreciate that and your leadership at the Fed. I grew up in the 70s. Got my Social Security number in 1973 when I was 12 years old. That's when I made my first payment. So I've been following the economy even as a youngster. And that was a really lousy time to enter in the workforce. Tell me, and I'm hearing discussions among some of our members now that would almost be reminiscent of discussions with prior Fed members saying, look, we got to lower interest rates and we've got unemployment out of control. So it sounds like we're taking some suggestions from some of my colleagues or plays from a playbook that didn't prove to be very effective back in the 70s. What can we learn? I'm not going to ask you about where you go from here, but if we look back into a postmortem on some of the decisions that were made when we had consistently high inflation, we had we had consistently high unemployment. What lessons can we learn there, or what mistakes should we not necessarily repeat? And I know that this is a fingerprint of a challenge. It's not exactly like the stressors that we had back in the 70s, but what can we learn from the decisions, what I think are arguably the wrong decisions made back then when we were dealing with high unemployment and high inflation? What did we learn?
I think the number one thing we learned was that it's up to the central bank to take it on and stick with it until it's done. And that doesn't sound controversial now, but it actually was back then. And so people didn't really get in there and get it done, and inflation kept coming back. I also think there were significant differences this time to the questions a minute ago. This is a combination of a supply side that we had very significant supply shocks along with big demand shocks from the reopening of the economy and from all the other things that happened. So I think we have to, each one of these things is different in its own way. We try to learn the lessons of history, though.
You agree or disagree? Any disconnect between inflation and inflation expectations from the 2% target should be addressed now and not at a later time?
Absolutely.
I like that answer. I want to go to something different. I'm trying to go into a lightning round now and finish on time. We've seen the 2024 stress test results for the U.S. banking system. It looks like to me, by every objective measure, we've got a banking system that's on strong financial footing. Do you agree?
Yes.
One last thing, as the Fed considers making broad and material changes to the Basel III proposal, back on that one, can I urge you not to overlook the second order issues important to FBOs and certain regionals to ensure that banks are not unduly influenced? If the current proposal, for example, the outsized operational risk costs were high, are we going to take care of that in any sort of reproposal?
Let me just say we're very conscious of the comments across the spectrum: foreign banks, domestic banks, small, medium-sized banks. Everyone's going to get heard carefully as part of this process. That is our obligation.
And I think in response to Senator Round's question, you did indicate there's probably, because of the nature of the likely changes from what Mr. Barr expected to what may ultimately come, we are going to open it up to comment again.
That's the strong view of the Federal Reserve. We're working on that question with the FDIC and the OCC to try to find a path to do that. But
Very good.
From our standpoint, that's essential.
I think it's a strong view from at least several members on this side of the dais here. That would be very, very important, because I think it's going to materially change. Thank you, Mr. Chair.
Thanks, Senator Tillis. Senator Warner of Virginia is recognized.
Thank you, Mr. Chairman. Chairman Powell, it's good to see you again. Coming this late in the questioning, I'm going to at least hit a couple of the items that my colleagues have otherwise already hit, because I make sure it's noted that I raised them as well. First of all, I want to agree with the chairman. You know, I probably hear more on housing and housing affordability than any other issue, and I agree with the chairman. I know we've discussed this around a rate cut, and I understand most of your answer, but I still want to add my 2 cents here. We've got to find a way to start bringing mortgage rates down and let people get unlock that housing market. And again, we've discussed the rate cut issue, and I know you've got to navigate that, but I hope it's sooner than later. I will not recap what I've done in the last couple hearings with you, but I do think the discount window proposal that I've gotten, that I know you're working on, before we think about additional regulations, and we do need in some cases, I think the discount window is an underused tool. Was one of the original tools for the Fed. A lot of my colleagues have talked about quantitative easing, Basel III Endgame. I do hope when we get the revisions that we'll see the quantitative analysis that, again, Senator Tillis already raised and other colleagues have raised. I also hope that one of the questions I raised in my March letter to you was, making sure any new regulatory structure, how it intersects with existing regulatory structure and terms of market risk, credit risk, and I, again, hope that we will have that as the revisions come out. I think one of the things that this debate around Basel III raised was that it is, my understanding at least, looked at, you may be all looking at revisions to liquidity standards as well, and wanted to see what you could say about that and whether that part of those standards are under review and what your thinking is.
Yeah, and I think that actually connects to the Silicon Valley Bank questions as well, where I think there seems to be a need to update assumptions about liquidity, and that's a separate proposal that we're also working on, and very important. I think we saw how fast that run was. It was just exponentially faster than prior runs. That's the new world, and that's some estimate of what that world is baked into things like the liquidity coverage ratio, for example.
Right, and wasn't that the case? If you had 25 cents on every depository dollar leave in 6 hours, no matter what the capital standards are.
Yeah.
And one of the things, I guess, there was a lot of talk after SVB that we need to think about internet-driven runs. A lot of us raised concerns. Candidly, I'm not sure I've heard any good proposals. So whether it comes from you guys or from folks listening, how we think about this new internet-driven world. And frankly, I think some of the irresponsible behavior by some of the folks that were major depositors in SVB who in many ways shouted fire in the crowded theater, and we've not seen any action there. So I would welcome additional ideas as well. And that kind of brings me to my last questions around supervisory reform. I know the GAO criticized the Fed's supervisory procedures in the role they played in the 2023 failures. It is a whole brand new world. Are we going to look at, will your changes to supervisory standards be comprehensive? Will they be one-off? How do you think about that in light of the GAO report, and also in light of just the SVB and the few of the other failures we saw last year?
Vice Chair Barr is, who's Vice Chair for Supervision, is leading a process of looking at the way we supervise banks and thinking about how we can be faster where it's appropriate, more forceful where it's appropriate. And I think, they've taken a pretty deep dive and tried to learn these lessons and then implement them in a way that is appropriate. So that's a big project going on at the Fed right now, which really Vice Chair for Supervision leads.
I think I remember lots of conversations with the chairman, with you, with the FDIC, and that Thursday through Sunday, and I think the solution you guys came up with, the administration came up with by Sunday night was a good one, but they were a pretty scary 3 or 4 days there, and it did seem like the process, I don't know completely how you get fully ahead of that, but I firmly believe that there should have been a clearer early warning system and trying to make sure that we wouldn't be in that kind of crisis situation going forward. And again, I would strongly encourage any additional thoughts on this technology risk and how we get that right. Thank you, Mr. Chairman.
Thanks. In order, Senator Kennedy of Louisiana is recognized.
Thank you, Mr. Chairman. Mr. Chairman, our economy is slowing, is it not?
Yes, although still growing at a solid pace.
Our unemployment rate is rising, is it not?
Yes, it is, although the labor market is still strong.
Our labor market is slowing, is it not?
Yes, but I'd say unemployment is still, is still low by historical standards. But yes, it is. We've seen cooling. Yes.
Mm-hmm. And I was looking at the recent jobs numbers. I know you've glanced at them too. About 3/4 of the net new jobs that were created in June were in government, healthcare, and social assistance. What does that tell you?
So that's a concentration. You'd rather see broader job creation than that. Those three areas have, in some reports, they've been, as it was this time, they've been the predominant creators of jobs. That tells you that job creation is becoming less broad in the economy and it's narrowing.
It tells you that government's creating those jobs, doesn't it?
Well, it's government. It's also in-person services. It's also some of it's government.
Manufacturing's been flat.
Yes, manufacturing's not creating a lot of new jobs these days.
Information technology shed jobs over the past 2 years, hasn't it?
I don't know.
Leisure and hospitality jobs have slowed to almost a trickle.
So that's a place where there was a desperate worker shortage, and they've done quite a bit of hiring, but they're catching up now.
I mean, 3/4 of the jobs that are being created in our economy can be related directly or indirectly to our spending deficits, can't they?
In this report, in this single report, I don't know that healthcare is really government spending. I mean, that's something people are consuming.
Where do you think these hospitals get their money?
They may get it, but I mean, people are not. The spending on healthcare is not necessarily directly related to deficits. Is my point.
I would disagree with you. I mean, here's my point. We talk a lot about expectations in terms of inflation. How if we expect there to be inflation, we'll get inflation. It seems to me that consumer expectations play a bigger role in the economy than we cede to them. Most of our economy in America is consumer driven, is it not?
Yes.
Unlike, say, China, which is manufacturing driven.
Very much so.
And I listened to you cite the statistics about the economy, but most Americans don't feel good about the economy, do they?
No, and we don't tell people how to feel about the economy.
I mean, isn't it a fact that most people, if you ask them to define Bidenomics, they would say that's easy. We get to pay more to live worse.
I wouldn't touch
you don't want to answer that
a sentence with that word in it.
Yeah. Yeah. I mean, we can pretty this up all I guess my point is, and I know you're going to do this anyway, but I'd be really careful with this economy. I mean, people just don't feel better off today. And one can marshal a persuasive argument that, well, you should, compared to Europe or compared to China, compared to Canada. But You know, feelings are feelings. People don't feel good about this economy. And it's primarily because of inflation. Let me use my final 30 seconds to ask you. I listened to my good friend, the chairman, give his opening statement. Do you think inflation was caused by corporate greed?
I hate to comment on something the chairman was speaking about.
Oh, go ahead.
Well, so I will just say, we see at the Fed, we see inflation as when there's an imbalance between supply and demand. And we use our tools to work on the demand side of that and bring it back into line with supply.
I got 2 seconds. So when are you going to lower interest rates?
I'm today not going to be sending any signals about the timing of any future actions.
Thank you, Mr. Chairman.
Senator Smith of Minnesota is recognized.
Thank you, Mr. Chair. Welcome, Chair Powell. It's good to see you again. I want to follow up on kind of the line of questioning that Senator Tester was on a bit ago. He was talking about how the U.S. economy has been outperforming other advanced economies around the world in terms of growth rates, in terms of unemployment, in terms of inflation, getting inflation under control, though I think we obviously can all agree that we're not, at least from my perspective, we're not done yet. And we don't want to rest on our laurels, but I'm wondering if you could share what you think that we have learned from this experience. What have we done right? And why is it that we are doing better than some of the other advanced economies in the world?
I think that it's down to the fundamental strengths of our economy. So as you may know, European economic officials are very, very focused on this question. They really, it comes up in all of our discussions. Europe has seen productivity increases of about 1% a year for 40 years. We've seen 2%. If you take a number and compound it at 1%, then compound it at 2%, the difference is just enormous after 40 years in terms of incomes and living standards. And their question is, why is that? Why is that? And the standard answer that Americans tend to give and that I would give is it's down to, more flexible labor markets. In the pandemic, people they stayed in their existing jobs. In the United States, we had people changing jobs at record levels. And, that's the kind of thing that adds to productivity and contributes to rising living standards, going back to school, getting skills and things like that. Another one is our financial sector. We don't just have banks, we have a highly developed ecosystem of financing sources that will fund early stage investments. Banks are really not set up to do that. They're prudentially regulated. And so those are some of the things. I think we just have these natural strengths as an innovative, more flexible economy. We can grow faster.
I appreciate that. I think sometimes there's a tendency to sort of trash our economy and to sort of say, oh, we suck. And actually, I think that there's great resilience in our economy. I would argue that it has also to do a lot with the incredible resilience of our workers and their creativity and their talent and the training and the education that they have. And I think I would also argue, though I wouldn't expect you to make this case, that the way in which our federal government responded to the pandemic in order to make sure that people weren't evicted, that they still had money to pay their bills even when they weren't able to work, meant that overall our economy, survived and was ready to kind of be off to the races when we emerged from the pandemic. But Chair Powell, I'd like to ask you a question, something that you and I have talked about, I continue to be thinking a lot about, which is the commercial real estate risk that we have in this country. I think particularly for office space. We know that has been under strain the last several years. The sector has remained largely stable, but we are hearing about some additional default risk. And one thing that I'm noting is that there's some expectation or concern that may fall disproportionately on smaller banks. I think that commercial and regional banks hold an estimated 2/3 of all the commercial real estate loans in the country. And so unlike larger banks, these smaller institutions might find it a little harder to deal with this. So could you discuss this with us? Could you tell us a little bit about how you see this risk and particularly whether this poses some additional risk that we might be seeing more concentration in the banking sector as these smaller banks are maybe under more pressure?
Yes, so this, to your point, this is a risk that has been with us and will be with us for some time, probably for years. And banks need to be, honestly assessing what their risk is. They need to be assured that they have the capital and the liquidity and the systems in place to manage this risk. The stress test that we apply to the largest institutions stressed commercial real estate pretty hard. And again, the conclusion is that the large banks can manage this problem. And most small banks can too, but it is in some smaller banks that tend to have that local concentration in commercial real estate. And, we're in touch with those banks. The supervisors and regulators are in touch with those banks and making sure that they can manage them. And it's going to be an issue for many banks, but it's one that we're trying to work through, one that we're very much aware of. And again, it'll be with us for some time.
Thank you. I think so much about the importance of these small regional community banks in small towns, even big towns in Minnesota, and how important it is that, in my book, that they can stay independent and better serve their communities in that way. So I worry about this risk. Thank you, Mr. Chair.
Thanks, Senator Smith. Senator Butler of California is recognized.
Thank you, Mr. Chairman. Chairman, good to see you.
Good to see you.
And I am going to make you do the whole last 5 minutes, since I'm the last one for today. You'll recall the first time that we spoke, I tried to engage you around 3 specific areas. One was how the monetary policy impacts the quality of life for young Americans in the future and the work that you are doing there, the space of climate risk, and what I see as potentially a future challenge down the road, and that is the state of commercial real estate. You and I have had that conversation before, and no surprises today. I'm going to stick to those 3 topics. Somewhat related to questions that you've been asked before relative to the housing market, housing affordability, and interest rates. I want to narrow the scope just a little bit to ask about those issues and challenges impact, again, the quality of life for America's next generation. Given the severe shortage of affordable and available homes to buy, coupled with high interest rates, young Americans are continually unable to afford homes and are pushed into a rental market, driving rental costs up. So there is sort of trickle-down impact here. A recent Washington Post analysis showed that Gen Z is spending 31% more on housing than their millennial counterparts were 10 years ago after adjusting for inflation. How do you view, that was a long lead-in to just ask the question, how do you envision or view the interest rates of today and the monetary balancing, policy balancing that the Fed is doing on contributing to the future generation predicament if we are to extrapolate the conditions of today?
So our job, of course, is the whole economy and inflation for the whole economy. And the absolute best thing we can do for younger people is to restore price stability.